Is real estate in Quebec still worth it in 2026? I get asked this question almost every week, and honestly, the answer surprised even me, because while most of Canada is cooling off, Quebec is doing something completely different. I'm Aguinaga, your Montreal real estate expert, and I've been working in the Montreal real estate market for almost 18 years. And today, I'm going to show you the numbers straight from the Centris database and the board's barometer, and you can judge for yourself. But before you get excited, there are risks you need to know about. I'm going to cover those too. Let's get right into it. Let me walk you through what just happened in Q1 2026. According to the QPAREB, that is the Quebec Professional Association of Real Estate Brokers, using data from the Centris provincial database, 23,354 residential sales were completed across Quebec. That is only 2% below last year, and still right at the 10-year average of around 23,500 transactions. This is not a market in decline. This is a market stabilizing at a historically strong level. Now, look at prices. Province-wide, single-family homes, median price is up 6%. Plexes, and this is the one that caught my attention, up 8%. Condos up 3%. In Montreal specifically, the median single-family price hit $652,000 in March. That is a new all-time high. Plexes hit $880,000, also a record. Meanwhile, Toronto is down almost 7% year over year. Vancouver is down 5%. Quebec is moving in a completely different direction. Here are 3 reasons why Quebec is different. Number 1, supply scarcity. Even though active listings on Centris grew 6% this quarter to 36,000 properties, that is still well below the 10-year historical average in every single region of Quebec. In Quebec City, inventory actually dropped another 4%. In Sherbrooke, down 9%. Properties are selling fast, single-family homes sold on an average of 45 days province-wide. In Montreal, 34 days for a single-family home. Plexes, 45 days. When properties are selling that quickly, prices hold firm. It is basic supply and demand. Number 2, a diversified economy. Quebec is not only dependent on one sector. Technology, education, healthcare, government, aerospace, the job market here is resilient. And that is why Charles Brandt, the board's market analysis director, pointed to when he described demand as strong, driven by stable interest rates and resilient job market. Compare that to Alberta, which is more tied to energy prices, or Ontario, where the tech layoffs hit harder. Our economic base supports consistent demand for housing. Number 3, relative affordability. Montreal is still significantly cheaper per square foot than Toronto and Vancouver. For an investor, that means a lower entry point with comparable or better returns. And for homeowners, it means your dollar goes much further. A property that costs $650,000 here would cost you over $1 million in the GTA. That gap is huge. Now, if you're an investor or thinking about becoming one, the rental side of this story is really compelling. In 2025, the TAL, the Tribunal Administratif du Logement, approved the highest allowable rent increase in at least the last 30 years at 5.9%, when heat is not included. This year, they changed the calculation, encouraging landlords to renovate their properties. Those who do will be compensated handsomely for the investment in their property. Now, vacancy rates in Montreal are around 2.9%. The rental market is simply stable here. Plexes are the standout asset class right now. Province-wide, Plex prices are up 8%, and in Montreal, the median price was $880,000. But here's what is interesting. Plexes are also selling fast. 50 days on market in Montreal. There is strong demand from both owner-occupants who want to live in one unit and rent the others, and from investors who see the rental fundamentals. If you're watching this and you own a property already, think about what your equity could do. A lot of people sit on $100,000, $200,000 in home equity and do not realize that could be the foundation of an investment property. We actually have a video coming up about a strategy called the Smith Maneuver that takes this concept to another level. Make sure you're subscribed for that one. Now, I would not be doing my job if I only gave you the good news. Let me tell you what to watch out for. First, immigration is slowing down. Federal caps on non-permanent residents are dropping from 7.6% to 5% by 2027. That has been a major driver of rental demand, especially in Montreal. Less population growth means less pressure on rents over time. Second, condos in Montreal. Condo listings are up 16% on Centris, while sales are softer. The condo segment is rebalancing. If you're an investor looking at condos specifically, be very selective about the location and building quality. Third, mortgage renewals. Over 1 million Canadian households are renewing in 2026. Many locked in at pandemic-era rates and are now facing significantly higher payments. That puts pressure on budgets. And fourth, trade uncertainty. The board described the outlook as cautious buyers who have become more deliberate in their decision-making due to the economic and geopolitical context. That is real. So, given all of this, what should you actually do? Here's what I'm seeing the smart investors focus on. 1. Well-located plexes with strong rental fundamentals. Not just any building, properties with leases at or near market rent in neighborhoods with low vacancy. Notre-Dame-de-Grâce, St. Henry, La Salle, parts of the West Island, these areas have strong tenant demand. 2. Leveraging stable rates. The Bank of Canada has held that 2.25%. Most major banks expect that to hold through 2026 or increase slightly, maybe by 50 basis points. That is a window of predictability. Use it to lock in your financing because multiple forecasters are suggesting rates could go back up in 2027. 3. Doing better due diligence. The board said it clearly. The market is entering a phase where quality and preparation matter more. Fuzzy financials and sloppy documentation do not fly anymore. If you're making an offer, come prepared. Pre-approval, inspection conditions, a clear understanding of the building's actual numbers. So, is Quebec real estate still a good long-term investment? Based on the Centris data and the board's barometer and what I'm seeing on the ground every day, yes. But, and this is a big but, only if you are strategic. The days of buying anything and watching it go up are long behind us. In 2026, execution matters, location matters, your numbers need to be real. If you want to talk about what a smart investment looks like for your specific situation, whether that it's your first property or your fifth, the link is in the description down below. Book a call and let's look at the numbers together. Next video, I'm going to show you a strategy that can literally make your mortgage tax deductible. It is a game changer. Subscribe so you do not miss it. Once again, I'm LJ Aguinaga, your Montreal real estate expert. I'll catch you in the next one.